Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about JIAXIN International Resources Investment Limited Annual Report. JIAXIN International Resources Investment Limited is a leading tungsten mining company with operations in the Republic of Kazakhstan. At its core, the company's primary business involves the exploration, development, and operation of the Bogyuti tungsten mine. This singular focus on tungsten mining sets JIAXIN apart as a specialized player in the industry. While the company's main activity is centered around tungsten mining, it does not provide a comprehensive list of its services or businesses beyond this core function. However, based on its primary business, it can be inferred that JIAXIN International Resources Investment Limited offers various related services such as mine management, exploration and development expertise, and possibly sales and marketing of tungsten products. In summary, the company's main business is tungsten mining, with a specific focus on the Bogyuti tungsten mine in Kazakhstan. JIAXIN International Resources Investment Limited market capitalization of $48 billion is significantly larger than the average industry peer of roughly $2 billion. This shows that JIAXIN International Resources Investment Limited holds a significant advantage in their industry. JIAXIN International Resources Investment Limited trades at a higher price-to-earnings ratio of 130 times and a lower price-to-book ratio of -1,542.03 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The company exhibits a very high leverage profile, with liabilities accounting for 101% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The company's financial performance indicates a positive trend in its operating cash flow. The net operating cash inflow of $24,511 on page 4 demonstrates the company's ability to generate cash from its core operations. Furthermore, the cash generated from operations of $510,367 on page 7 is also a positive indicator. Additionally, the operating cash inflow after working capital changes of $111,011 on page 12 shows that the company's cash flow is not affected by changes in working capital. This suggests that the company's management is effective in managing its working capital and generating cash from its operations. The net cash generated from operating activities of $510.4 million on page 17 reinforces this positive trend, indicating a strong ability to generate cash from its core business. Overall, these indicators suggest that the company is indeed generating positive operating cash flow, which is a key indicator of financial health and stability. The company's debt level and interest expenses have undergone significant changes in recent years. In terms of debt level, the non-current borrowings have seen a substantial decrease of 99.9%, indicating that the company has managed to reduce its long-term liabilities effectively. However, current borrowings have increased by 20.6%, which may raise concerns about the company's short-term liquidity. Despite this, the total borrowings have decreased by 23.5% from $1,665 million to $1,265.5 million. Regarding interest expenses, there has been a notable decrease of $55 million in interest paid, and a reduction of $119,000 in interest expenses from $6,722,000 to $68,603,000. This suggests that the company's debt burden is becoming less costly, which could be attributed to lower interest rates or more favorable loan terms. Overall, while there are mixed signals regarding the company's debt level, the decrease in interest expenses indicates a positive trend for the company's financial health. The company's financial strategy has been focused on growth and expansion rather than distributing profits to shareholders. According to the latest annual report, one of the key points highlighted in Section 9 is that the company has not paid dividends or bought back shares. This decision suggests that the management is prioritizing investments in the business over returning value to investors through dividend payments or share repurchases. Concerns about inventory buildup or supply chain disruption are valid due to significant increases in various costs. The substantial rise in consumables costs from HK$0 to HK$129,136 is a notable concern. Additionally, outsourcing mining services has also seen a considerable increase from HK$0 to HK$124,596. Furthermore, transportation and delivery costs have risen from HK$0 to HK$15,562. These increases suggest potential strain on the supply chain, which could lead to inventory buildup or disruptions if not managed effectively. That concludes the financial summary for JIAXIN International Resources Investment Limited. Feel free to comment below, and I will be happy to answer them when possible.